Hey guys, what's going on? One of the questions that I've been receiving a lot of the past, let's say 2 weeks or so is, how high do I think stocks could go? And I keep reiterating the same thing, that question, which is really what's been our case for the past, let's call it a year or so, is that stocks are just basically capped. However, since we have to be open to all potential outcomes, what I wanted to do here today and take a few minutes on is to understand what we would need to see in order for stocks, let's say the S&P 500, to break to more sustainable highs. Not just a break towards 3,000 or 3,100 or something and then just go right back down, but something that's sustainable. And that analysis starts by understanding the makeup of an index and the makeup of what are the big weights. Right? Unless you understand that, it's very difficult to really contextualize things in the market. Like I'll give you some examples here. Let's just go to the chart. Stop yapping, Serge. Okay, so what we do first of all is we need to have an understanding of what are the important sectors in the market. So in order for that, and none of them are unimportant necessarily, but here you can see on our Market Rover platform, which is this thing, which is amazing, gives you trade ideas, pop-up trade alerts, everything. Daily commentary, whatever. You can see which ones are the more heavily weighted sectors. There's a little percentage number. So for example, you can see that financials, let me take my pen, the financial sector makes up, let's call it 13.5% of the S&P 500, and technology is almost 21%. Now there's other important sectors in here, right? So for example, you can see healthcare makes up 15%. But financials are important because they touch really everything, every part of the economy, and of course technology being a really big weight. So basically, in a nutshell, those are the two sectors we need to see act well and really pretty much gain leadership. Now, tech has been acting okay, but I'll show you guys within that. Again, it's important to understand what makes up an important part of tech to understand that. So let's do two things. Let's understand tech first and what we need to see there in order to get more sustainability for the broad market from tech. And then we'll look at the financial as well, because those two parts of the market, in my opinion, need to show real leadership and sustainability on the upside if we want to see the S&P break higher. So let's start off with what do we say with tech? Let me flip this around. And what we're going to do is we're going to look at, I think my lens is dirty, so maybe we'll quickly wipe that. What we're going to look at here, first of all, this is the S&P 500. I guess it's probably a good way to start. And you can kind of see this megaphone pattern. What does that mean? Well, it means that we've basically, over the past year and a half, so had this is a monthly chart in the S&P 500, like a long-term chart. Like each bar is 1 month. Again, for perspective, I think that's really important. And you can see that we've kind of, when we reach the upper end of the trend, we go down, and at the bottom end, we would go higher. And I think my case, ultimately, it still is that ultimately, once we get up here, maybe 3,000, 3,100, whatever, we'll then ultimately find our way back lower. But let's assume that's not going to happen. And what would it take in order for the S&P to really start basing here and then just ultimately go much higher? Well, there's two things. First of all, like I said, start with technology. Within technology, we need to look at semiconductor stocks. The SMH ETF, you can look at the SOX. There's other things, other ways of looking at semiconductor stocks. But these are your stocks like Intel, NVIDIA, whatever, like Hewlett Packard, and many, many more of the big names in this space, Applied Materials, so on and so forth. And you can see that on a long-term chart, again, this is the monthly long-term chart. Right now, what's happening, and what's been happening literally since 2017 or so, is that semiconductor stocks are basically kind of contending with these highs that we had in 2001. We're breaking above it, breaking below it, and now breaking back above it. The trouble that I'm seeing is that we still have this bearish reversal from May, which is this red bar. You may not be able to see it so well. It's right here. Let me go a little closer. This one right here, to contend with. And I think that was an important bearish reversal. And until we kind of see that being worked off, I don't think technology as a sector, much less semiconductor stocks, can really start breaking higher and give enough support to the S&P to push higher. That's number one. Again, that's just my opinion. Again, tech being 20%. In fact, it's more than 20% if you look at some of the other parts of the market that are actually still tech, even though the S&P has recategorized them. The other part of the market we look at is financials. And this is, again, the monthly chart. Here we're looking at the financial sector. The XLF is the ETF, again, on a monthly basis. Now, it looks very good. It looks promising. You can see we're kind of coiling up against this diagonal line to keep it very simple. The trouble is, and this is why it's so important to look at the calendar, is that banking stocks are about to report earnings. So earnings season for the second quarter is about to kick off, and banking stocks are to be in focus. They're always the first ones to report. So there's no way I would ever go ahead and get ahead of a curve here and do a trade in banking stocks until they've reported earnings. But we want to watch this very closely, because if these stocks are, they've been basing out, they had some good moves, if they can really get it together and start moving higher, then that will be another important piece to see more sustainability on the upside in the S&P 500. So I'm hoping that the takeaway here for you guys is that you can see that it's important to not just look at a chart, not just look at a breakout. You have to contextualize this. And the way you do that is by understanding the makeup of, say, a sector, a group, what drives it, what are the fundamental drivers of it. You know, those are important things. And if you combine that and marry that with maybe some structural analysis and maybe some technical analysis and sector and group rotation, which is what our Market Rover does so well, and that's why people love it so much, I think you have an amazing chance to make a ton of money in the market over time. Hope this is helpful, folks. Have a great day. Talk to you soon.